All right, welcome back, everybody. This week, Paul and I are going to uncover the things we need to unlearn when starting and even going through our infinite banking journey. We also talk a little bit about some lawnmower hijinks that occurred over the weekend. But yeah, what'd you think of the episode, Paul?
Yeah. Yeah, I like the opening talking about the lawnmower experience up in Minnesota. I think that's people will find that pretty funny. But no, we talk about unlearning. That's part of, what Nelson talks about in the book is the problem. And for a lot of people, exploring IBC is unlearning I think the conventional wisdom that exists out there, whether it be about investment return risk or debt, if you're a Dave Ramseyite and all debt is bad, whatever, and some other things. So yeah, we get into it, had a good time, enjoy.
Hey, I'm Dave,
And I'm Paul.
and this is the Wealth Warehouse Podcast. Well, long time no see, Paul.
I know, it's been forever. It's been days.
It's been at least a couple days. Feels like forever. Yeah.
Yeah.
Well, we had a fun
People-
weekend.
Yeah, people generally miss me when I'm gone, so
Yeah. That's my favorite
time.
Brooks and Dunn's song. You're going to miss me when I'm gone.
yeah.
Yeah.
But no, I was just up at Dave's house, and I spent the weekend there with my son Anthony for Dave's retirement from the Minnesota Air National Guard. Or is it just the National Guard? Is it the Air Guard?
It's the Air Force and the Air National Guard all together.
All together. Yeah. And it was great. You got to see your A10 pals again. It's always fun.
Yep.
Definitely. And
Never
then,
dull.
Never dull, always fun. Just and I think I like that community too. It's just a bunch of like-minded people and they have a good time. But it was just good to celebrate your career and all your achievements and stuff. And I got to teach. I taught. I'm Dave's family's resident car referral
My surrogate mechanic.
surrogate mechanic, encyclopedia, and I'm not, I don't know everything, but I know a little bit.
I don't know. You just called
Well-
yourself an encyclopedia, so it kind of sounds like you know everything.
I do know a lot.
Yeah.
Pretty good at trivia. But so we're up there, and I see Dave's youngest son. He's cutting the grass, doing a great job, and I'm listening to this lawnmower. I'm like, man, it sounded okay, but it just sounded like it was, I don't know, something like there was metal on metal contact going on in the engine. So I'm like, hey, let's go. Have you changed the oil in this thing ever? He's like, no. Dave doesn't.
I mean,
do
this
that.
is only the second. I guess I've had it 2 years.
He's had it 2 years.
Yeah.
So we go in the garage. He's got some oil, and we're gonna tip it over to drain it into a Coors Banquet bottle using a. What were we using for a funnel? Did we?
A
Oh, we
funnel.
had a funnel.
An actual funnel.
Yeah, an actual funnel. So we tip it over. Dave and I pick it up, and his son is holding the funnel in place with the bottle. And we know it's going to take 2 bottles, so we're going to tip it over, get the initial oil out, and then stop, and then do the other bottle. Well, we're tipping, and everyone knows what's coming. Nothing came out of this thing.
Nothing. Bone dry.
There was no oil in it.
Yeah. Yeah.
We're not sure if there ever was, aside from at the factory when they tested it. So
Yeah, I'm sure there was because that bottle that we emptied into it was opened
yeah,
and it wasn't
So you
all the way
just
full.
Had some oil in it.
So I had some oil in there, but I'm not, I don't do much when it comes to, I don't enjoy taking care of stuff, which is why I don't have a lot of stuff, which is why I
Like
don't want pets in my
like
house.
pets. And what
Which
do you
now I
have now?
3.
Now he's
We
got
have
a pet,
a rabbit,
bunny,
a dog, and a fish.
and that's right. How is
Yeah.
where is Donnie? Oh, he's at the house.
Donnie's at the house. He's in the office. I have to clean the water,
Okay.
but he's still alive. So everybody
Okay.
thought he'd be dead within 48 hours, but I'm keeping him alive.
Yeah. Well, that's good. I'm glad Donnie's doing good. He was a good-looking fish. So anyway, we wanted to kind of just lead off with just a funny, lighthearted story about, obviously you wouldn't hire Dave to maintain your lawn equipment, like your weed eater and your
Fact.
lawnmower.
100%.
But you might hire him to be your infinite banking concept life insurance agent, right? Because that's what he knows, that's what he is good at and passionate about. So
Correct. Yeah. And today we want to talk about really unlearning. That's part of kind of the whole process everybody goes through when they discover infinite banking. They realize they're looking for something, they find this, and they say, maybe this is what I've been looking for. But what it comes along with a whole lot of unlearning, and especially for people who maybe have been paying attention to finances and have been, looking at their investment portfolio, working with the banks, leveraging money, things like that, but doing it in the conventional way that we're all told to do it. Following the blueprint that the bank hands us and says, do it this way. So there's a lot to unlearn. Just like when you start digging into real history, there's a lot to unlearn depending on what you learned in school and how accurate that was based on what real history is.
yeah, likely a lot of partial truths in what you learned in U.S. history specifically.
Right. And a lot of incomplete understandings.
Yes, for sure.
Yeah, so you got to peel the onion back. And that's what we're going to talk about today. So is like, what things do you need to unlearn to make your IBC journey successful, or to maybe get into infinite banking? Or a lot of you listening already have policies in place. You're already being your own banker, but there's still some unlearning. It's not like, you haven't hit the arrival syndrome. You've never arrived. So there's always more to change about the way you think. So Paul's story so kindly illustrated how one of the things we need to unlearn is the idea that you don't need to understand money. In my case, I didn't think I needed to understand lawnmowers and taking care of them. But by Paul discovering that I was lacking something pretty essential for the longevity of that motor, he probably saved me a few $100 next summer.
Yeah,
having to buy a
for
new one.
sure.
Right?
It would have seized eventually.
Yeah, exactly. So that was good. But a lot of people think, I'm going to make money. I don't need to understand how it works, and I'm just going to go give it to my financial, babysitter, my money manager, or whatever.
Yeah, my
And I don't need to.
babysitter,
Yeah, I don't need to understand anything because they're going to do it for me. Well, that's I got to say it. That's a really dumb way to go about life, and especially with one of the most important things in your life, which is your finances.
Yep. And I agree with that 100%. I don't have a lot of clients like that, but I have a few, like I'm thinking of one particular person at this point who's just like, Paul, I trust you. I just want you to do it, and I'll try to understand it. And of course that's less than ideal,
Right.
and that person doesn't understand what's going on, and they don't really know what to do, right? And they don't pay premium worthy of their income. They pay a little tiny premium, and now it's just the base. It's just like,
Yeah.
But anyway, yeah, totally get it. You need to understand becoming financially sound and creating generational wealth that lasts beyond your life is done with purpose and intent. It's done deliberately, and it's not going to happen by accident either.
Right.
Wealth isn't going to fall out of a tree and hit you in the face.
And if it does, and you don't learn anything about it, it ain't gonna last.
It ain't gonna last. You're gonna lose it. Like all these people that hit the mega millions, and then within 5 years, it's, the 10 million they had they don't know where it went, but it's not
It's
with
gone.
them anymore.
Right.
Right.
Yeah. So you need to understand money. And the first part about this episode is really also about identifying the problem, unlearning the wrong things helps you see what the problem really is. And Nelson always says, if you know what the problem is, you'll know what to do.
Yep.
So you got to uncover the problem. So again, hopefully everybody listening here, I think anybody listening wants to understand money better, wants to understand banking, and maybe even wants to understand whole life insurance better. So you're in the right place, and good for you.
Yeah, hopefully, because that's what this podcast is about.
Yeah. Otherwise, yeah. Otherwise, maybe you're just one of our wives who are, just being nice and listening to our podcast and want to give us some feedback.
Tammy really liked this week's.
Which was, well, this week. We did, I guess we don't know exactly when this is going out. You mean the most recent one?
Yeah.
Okay. Yeah. So you're talking episode 174? Mm-hmm. What happens if I lose my job? How do I pay my premiums? Yeah, that's a great one. Because that's a question we had. So go back and listen to that one.
Go listen to that one. A lot of people, again, just to hit on it real quick, how do I pay my premium for a long duration? I'm in my 70s and 80s and not laboring anymore. Your questions will all be answered on that episode.
Yeah. Nice. All right. Well, let's talk about another item that we need to unlearn. We need to unlearn this idea that the banks are the only place to store and grow money. I mean, from a young age, even every little child out there knows what a bank is. And they know, banks have money, right? That's Willie Sutton's law.
That's why he robbed the banks, because that's where the money is.
That's where the money is. Yeah.
Yep. Yeah. And I remember taking my paper route money, starting at age 9 all the way through age, 14 or 15, whenever I stopped doing that, but taking it down and depositing the cash, and that you had your little bank book, and they put it in that little dot matrix printer thing, and it would spit out the deposit and the new balance, right? And I always thought that was great, and you could see the interest that you earned every month, whatever. And of course, these young people have no idea what the hell I'm talking about, but that's the way you did it back then. Now you just log in.
And there was no cooler feeling. Like, that was like welcome to adulthood. I felt like a real adult when I was maybe 16 and got my first checking account.
Yeah.
And I had checks. Maybe I had a debit card. Did they have debit cards back then? 30
Yeah,
years ago?
I didn't have any of that until I went to college.
Yeah, I think maybe there were still ATMs.
They were. Oh yeah, they were for sure.
So I
remember other people had them, and I was like, "What is this?"
Yeah. But that was so cool. I was like, "Yep, all my money's there. It's safe. It's protected. I can access it with this card right here. I'm the man." Yep. But that's how we were brought up to feel, and that's how conventional wisdom and conventional mainstream finance teaches you that you should put all your money in the bank and carry this little card around, and whenever you need access to it, you got it. And that's the only place to put it.
The only place to put it. And of course, other people have figured out that that's not true. There's many places you can store money. In our case, we like to store money, the value, the cash, in whole life policies, right? And for all the reasons you've heard on 170 plus episodes on this podcast, and that's why we do that. But wouldn't it be nice? Like, I remember thinking this as a kid, Dave, where I was like, man, people with BMWs, right? To me, they were rich. We were driving Dodge Caravans, and they had BMWs or Mercedes.
And then you learn, when you get older and you learn more about money, you realize most of those BMWs are leased.
They're all
by
leased.
people who can't afford to buy one.
Yeah, that's true. And Nelson says that in the book too.
Yeah.
But I remember thinking, like, I remember one family we grew up with, they owned donut shops. Not like Dunkin' or like private ones, but they were really good. And I was like, man, and God bless my parents, they did fine, but they were working people, a nurse and a mechanic. And I was like, oh, we're never gonna have those things. But I was like, I want to know how they do it.
Yeah.
Like, I was attracted to that at that young age. This is 8, 9, 10 years old. Like, what are they doing? Well, they're not just sitting on their butt waiting for the wealth to fall out of a tree and hit them in the face. They're out there, starting a business, running a business, expanding a business, selling a business after it's where they wanted to, opening and starting another one.
Yeah.
It takes effort, but it takes learning, right? You got to learn the right things. And that's kind of the theme of this episode. You can't just sit on your butt.
Yeah. So you got to unlearn the idea that the banks are the best place to store your money, or the only place, because it's not actually there. You go deposit $10,000 in a bank, You go back the next day, they may not have $10,000 in cash to give back to you.
Yeah, I don't think people realize that. They have very little cash, in fact.
I always call the bank before I go make a withdrawal. I said, hey, I'm going to come in. I'm going to get $10,000 in cash. Okay?
Do you have it?
Yes. Just to make sure you know I'm coming for cash.
Yeah.
Okay. And they're like, oh, well, thank you for calling ahead and letting us know.
Yeah.
So seriously, call your bank and just tell your bank, I'm going to come in and withdraw $50,000 in cash and see what they say. They'll probably...
You ain't going to make any friends.
Yeah. No, you get treated like a criminal too.
Yeah.
When you sit there and withdraw cash, and they want to know why. Why do you need this cash? What's it for? None of your business. How about that?
Right. Luckily, I bank with two banks that there's almost never a branch near me, so I can't do that.
Yeah. Well, so we think our money's in the bank. It's not. Where is it?
It's being lent back to us.
Okay.
That's where it's
at more than what we're earning on that money.
Yes.
Right?
That's right.
Yeah.
And if you want to get a little breakdown on that, but on how all of that works outside of becoming your own banker, how privatized banking really works is another book that Nelson Nash put out and the Institute put out several years ago, 2012 maybe. And that is a good book that kind of gets into the fractional reserve lending system and what is actually happening in the U.S. or really the worldwide banking system.
And don't be scared. It looks like a really big book. It's pretty thick, a couple inches thick, but it's an easy
font.
read, and it's big font, and it's simple.
Yep.
Yeah.
And you'll learn something.
Yeah, for sure. So we need to stop. We need to unlearn this idea that we need to rely on banks as our primary financial tool. There are other places to store money, and for generations, Americans stored a lot of their capital in whole life insurance.
Yep.
Until they allowed regular everyday Americans to start investing in the stock market, and doing a 401k. Life insurance is where most people stored their money.
Yeah, not a bad place to put it.
Yeah.
Yeah. The advent of the mutual fund, I don't know what year it was, 1935 or something, or whenever it was. That's kind of when you saw the begin of the decline of whole life insurance as a place where people put money. Not all of their money, but put money.
Yeah. I mean, it was just a normal thing to do.
Yeah, very normal. Very traditional.
Normal. Yeah. Like people didn't look at you weird when you said, I own whole life insurance and I have this much equity in my contract.
Yeah, in some circles you say that now you're the devil.
Yeah.
And you're an idiot.
Oh, you must sell it.
Yeah, you must
have
sell
an
it.
angle. You have an ulterior motive. You're doing it for the commissions. Anyway,
Yeah.
I think we talked about that on one episode.
Oh yeah, sure.
But if I was in it for the commissions and the money, it'd be a lot easier to sell pharmaceuticals.
That's
or
right.
medical devices.
I could have sold that vaccine, the jab.
Yeah, it's pretty easy to sell when it's free.
Here you go.
Yep, here you go. Uncle Sam paid for it.
Yep.
Yeah.
Meaning you did with your tax dollars
Right.
and or inflationary spending.
Yeah. Anyway, whole other episode. So, let's talk about debt.
Yeah.
Because one of these notions that the banks, so it's kind of competing interests. The banks may want you to view debt as a good thing because that's how they make money, is by making you a debtor. But conventional financial advice is pay down your debt as quickly as possible. All debt is bad debt. And I don't think many of our clients still think that, if any, that all debt is bad debt.
No,
But
no,
yeah.
they certainly don't.
Yeah. Not all debt is bad debt. But how does life insurance, when we're talking infinite banking and borrowing against your cash value, isn't that a debt? And how is that not bad debt?
I do have some clients that think like that. They're really hesitant, and I've mentioned it on the podcast before. They're really hesitant to borrow against their policy. However, they were forced to, and they don't listen, but I said it to
They
their
don't listen
face.
to you, or they don't listen to the podcast?
Neither, because I told them, on the theme of the future is unknown. You never know what you're gonna have a need for cash, your need for liquidity, and there's the same people that paid off their house. So $800,000 house, completely paid off. Building another house made their lives more difficult, right?
Yeah.
Where instead they could have $800,000 of life insurance cash value, a phone call away,
Yeah.
a piece of paper away, right? Anyway, so we've talked about how, I would say if you're a person that's got, $50,000 of credit card debt, that's bad debt.
Sure.
And you should get rid of that as soon as you can through any means necessary, working harder, being smarter, whatever.
Selling
and
a
to
kidney.
selling a, yeah, you only need one, right?
Yeah.
We were talking,
But you can't make money doing it, unfortunately. So
no, right. There's no free market for it. No. So even if I wanted to give you my kidney, I'm not. No. Anyway, but we have learned that not only does we have, when you borrow against a life insurance contract, it is the best terms you will ever find in a loan. There's none better. It's completely unstructured. There's no repayment schedule, right? Interest rates are favorable, right? Between 5 and 7%.
It's almost like borrowing from your grandmother, right? If your grandma was just a super nice and just pay me back whenever you feel like it, honey.
Right. And you want to do right by grandma, and you do want to pay her back because maybe she'll lend to you again, right?
Right. You pay it back, she'll lend it back out. Yep.
But I think the IBC mindset, most people are, they're tied to the banks, they're wed to the banks, and therefore it's constraining other things they may do or may see in their financial space. Whereas the IBC mindset, it's more independent, more picky, more strategic with how we utilize our funds, right? We're not abusing our life insurance cash value. We're going to go use it for a specific purpose. Pay for a retaining wall for a pool, finance an investment, maybe do some sort of note investing where the cash flow repays the policy loan, then you rinse and repeat and just keep doing that and build out that cash flow snowball. Whatever. People are going to do what they're going to do. But you're not going to do it, at least from the IBC perspective, if you're not borrowing against the cash value of your policy, because that's how you're going to do it. You don't want to do a withdrawal, right? You don't want to interrupt the growth of that policy permanently. You want to take loans.
Yeah. And that's one of the great things about taking a loan against your cash value is it's going to continue to grow uninterrupted, because you're just leveraging your equity in your death benefit, which is your cash value. You're not taking it out. So yeah, it's great.
Yep.
And it does combine, in Nelson talks about the saver, the debtor, the wealth creator. The saver saves up and goes to buy a car, drop back down to zero. Then they save up and drop back down to zero. The debtor starts at zero and climbs back up to zero. They start below zero. Back up to zero.
Yeah.
Right. But the wealth creator is a constant upward trajectory that looks more like a hockey stick, because the longer you're doing this, the more it's compounding every single year.
Gets better no matter what.
It gets better no matter what, more efficient no matter what, as long as you're paying your premiums.
Yeah, which is what you signed up to do. So that's great. Good.
Yeah.
I'm on Dave Ramsey's Facebook page sometimes, and I make, I think helpful comments. But one guy was saying that something about reducing my premium. He's like, you should be using that to reduce your premium, or if it really worked the way you said, your premium would go down. So complete knucklehead, doesn't know anything about what he's talking about.
Right.
But I asked him, I was like, why would I want my premiums to go down?
Because he's viewing
It's gonna make his head explode.
That would make his head explode.
It probably already exploded.
Because he can only view those as one thing,
right?
As an expense. That's it. Yep. That's the only way somebody like that can view that.
Greedy insurance company, greedy life insurance agent. Just what an idiot. Oh my God.
Yeah. But I bet this guy loves his health insurance agent and the health insurance company, right? Talk about greedy.
Yeah.
Yeah.
So
anyway, not all debt is bad. Debt is not always bad. And debt, even You can consider it debt because it's a loan that needs to be repaid back, even though you already own the asset that's guaranteed to pay that debt back anyway.
That's right.
The death benefit, right? So you already have a guaranteed way to repay that debt. It's just going to benefit you to repay that because then you can use those dollars all over again. But that debt doesn't show up as debt on your personal balance sheet,
Nope.
on your debt to income ratio, like with the banks. That is not debt, and it doesn't affect your credit score, doesn't impact that whatsoever. Nobody sees that you have that debt. Who's going to be able to find out? If they're like, oh, how much money do you owe in the insurance company? Well, none of your business. It's a private contract between me and the insurance company, and the fact is I don't owe them anything except my premium.
So, like you said, it's going to be paid back. Now, you should if you take a policy loan, you should never take one without making provisions to repay it, either in, structured payments every month or every quarter, or some sort of windfall that you anticipate, kind of like I've talked about recently. You should, because remember, you part own the company. I part own the company. Dave partly owns the company. I want to make the company as strong as possible. And I'm going to do that by giving it capital back that it can loan. Maybe it's loaning it to you, or it's going to buy, some sort of commercial building or whatever it's going to go do. But it helps strengthen its overall portfolio. And that's what we want, right?
Yep. All right. Well, let's hit one more point and then we'll end it and come back next week with the rest of the points because we got several more. So one of the other things we got to unlearn, and this is one of the toughest for people, is that focus on rate of return and this idea that high risk equals high return and that I got to put my money at risk in order to make anything on it. Otherwise, what am I doing? I'm losing if I don't put my money at risk.
Right.
So what is risk? Risk is probability of loss. Mm-hmm. So you're saying I have to put my money in a position to lose in order for me to win. Is that the dumbest thing you ever heard when you say it like that? It's the dumbest thing you could ever say.
Yeah, and that's, early in my getting advised financially, one of the biggest things at that brokerage was, what is your risk tolerance?
What's your risk tolerance? And of course, you're like 23, 24. And even at that time, I remember getting that same question. I was like, I don't know, pretty low. And they're like, oh, you mean you're probably pretty medium or medium to high because you're
moderately
young, right?
aggressive.
You're moderately aggressive. You're moderate. So they basically told me what my risk tolerance was. And because I had 40 years to make up for any losses, it should be moderate to aggressive. Yeah.
And then I put all my money in mutual funds, which underperformed. And I did it for a long time. Anyway, not a dig at them, but
kind of.
Kind of a dig at them.
Yeah.
For sure.
Yeah.
Front-loaded mutual funds.
Front-loaded mutual funds, which were deemed
50%.
illegal, and they had to pay us back. And then when they paid us back, they tried to say, hey, if you don't want to cash this check, you can just keep it as a credit for one-on-one financial counseling.
Which I was already getting.
Yeah. I'm like, I didn't know I was paying for that in the first place.
Yeah.
Gotcha.
Oh, man.
So this whole idea on high returns, and we hit on this in a couple of recent episodes, I believe last week's episode and episode 169, where we're talking about quit focusing on the high returns, on that 10% of your income that you're investing. Because if you shift your focus and focus more on that 90% that's slipping through your fingers every month and capturing, say, 5% of that, you're going to be 5 times ahead of where you would be if you're just earning 10% on your 10%.
Yeah, and we went into pretty good detail on that. But just like Nelson says in the book, the only money that you can spend is money that you have after taxes. Right? Your after tax or your net income is that's what you have to invest, spend, donate, whatever, right? Live.
Yep.
And 34.5% of that is for the average person, the typical person is going to interest to somebody else's bank.
Yeah. And most people probably don't think they're like, well, there's no way I'm paying that much in interest. Well, look at your amortization table on that house you purchased in the last couple of years. And you'll see how much of that payment you're making every month is going to interest.
And then don't forget the closing costs.
And the closing costs that were involved, the PMI, the private mortgage insurance,
If you have that, yeah.
if you have that, yeah, all of that. That's interest that's going to somebody else.
Yeah.
Now, I'm not saying you're going to be able to buy a house with cash after just starting a policy, a whole life policy a couple years later. That's probably not going to happen for the majority of folks. It's going to take you a long time, but it's never going to happen if you don't get started at all.
Yeah. It's going to take the average person 20 to 25 years to become their own banker.
Yeah. Which
And
I'm
if your
excited
government
about.
keeps printing money the way it does, it'll take
Yeah.
longer.
Yeah, because I'm 15 years in. I think in another 5, I might be at that point where I could always just take a cash loan to go buy or build a house.
Right.
Yeah,
Yep.
pretty
But
exciting. to
you've
think
been
about.
paying an appropriate premium to accomplish that.
And an appropriate premium, an increasing premium
Increasing.
based
Right.
on what the appropriate level is now, not what it was 15 years ago when I started and I was a young captain in the Air Force.
Right. If you were still paying, the premium from 2000 whatever, 2010, it would be meager compared to the premium you pay today.
Yeah, I think I started and I was paying about $11,000 a year between 3
That's
policies.
pretty good.
Which was pretty good for what I was making. I was making less
Single-
than 100,000.
Yeah, and you were the lone breadwinner at the time.
Lone breadwinner, and I was still able to put that much away, which was significant at that time. But if that was all I was doing today, there'd be no chance I'd be anywhere. I mean, it would be completely insignificant.
Correct.
Yeah.
Yeah, that's important. That's really a critical point, folks, is you're not going to pay the premium Dave pays or I pay. You might pay more because you make $10 million a year or something. Or maybe you're making $65,000 a year. But your premium should be appropriate for you. Don't forget that. It's appropriate to your situation.
Yep. And your situation changes year over year. And ideally, if you started a policy 5 years ago, you're probably better off now than you were 5 years ago. Maybe it's time to reevaluate how much premium. You just look at it as a percentage. Now, what percentage of premium am I paying relative to my total income?
Correct.
Yeah.
That's exactly how I did it when I was doing the military's thrift savings plan, right? I set it at a certain percentage to max it out. Such a good boy. But every year, you get the pay raise or a promotion or whatever, I'd have to actually decrease the percentage over time, which put more money back in my pocket. But it was the behavior was correct. The mindset was correct. But of course I wasn't thinking, this is lifestyle money. So my mindset was wrong. I should have been like, where else can I put this extra money that I have now?
Yeah, exactly.
And that's all I think about now is where can I put this extra money?
Yep.
It's either premium or loans. That's it.
Yep. 100%. All right. Well, cool. That's pretty good. We got several more points we'll cover next week. So hope everybody got something out of this. Reach out with questions, input, topics, and don't forget to leave a comment. We rarely mention that, so leave a rating and a comment for us on whatever podcast platform you're listening on, or on YouTube. So that's all I got. You got any closing parting shots?
No parting shots today. I think I just had one.
Okay. Well, you took a shot at me at the beginning of the episode, so that's all
Not
right.
a shot. Just it was fun. I mean, it's funny to think about.
It
We would
is.
have nothing to talk about if we, if 2 years from now or end of this summer or something, the engine seized on the lawnmower.
Yeah, I would have been really confused. Hey, what, Paul? Dude, my engine just quit. I don't know what's happening, man.
Like
Yeah.
you wouldn't be able to. I don't think you'd be able to even pull the rope.
Oh, really?
Well, no, because
Yeah,
those
maybe
are those are like rotary engines, right?
Yep.
Like
Yeah. All right. Well, good. It was a good learning weekend. So
yeah, the
I'm
boys
glad you
learned
came up.
something. Yeah.
Yep.
We all
Absolutely.
Yeah, so it's good.
All right, everybody. Have a great week. We'll see you next week. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.